Welcome, everyone. We're diving into some intriguing dynamics in the Ontario mortgage market today. Think rate cuts, trade tensions, and what that means for both buyers and banks.
I'm all ears. It's a lot to unpack here. What's the headline change we're looking at?
Well, the Bank of Canada just trimmed its policy rate by 25 basis points, now down to 2.75%. This marks the seventh straight cut, which is quite a persistent move. It's shaking things up, particularly for those with variable mortgages.
Right. So with variable rates dropping fast, people could see immediate relief in their monthly payments.
Exactly, and that's something mortgage broker Ron Butler highlighted. He mentioned that while homeowners on variable products are likely to benefit, the tilt between choosing variable or fixed mortgages will hinge a lot on your job security.
Yeah. Interesting. So for folks in stable roles, a variable might be the way to go. But if you're not so sure financially, sticking to fixed might be safer, huh?
Precisely, and it's a bit like choosing a speedboat versus a sailboat. You need to know if you can handle the pace. Now, here's something else. While the rate drop offers relief, economic headwinds from a trade war with the U.S. are stirring up some turbulence.
So despite lower rates, there's a sense of caution due to these trade tensions.
Yup, and experts like Victor Tran point out that even with the mortgage rates looking friendlier, the overall market mood remains unsettled. He argues the unstable economic environment could deter potential buyers from diving in headfirst.
That's a bit contradictory, isn't it? Lower rates should attract buyers, but caution in the economy might cancel that out?
I get what you're saying, and it's a fair challenge. Butler himself noted this paradox. As tariffs and trade worries loom, we might see heightened competition among lenders, leading to aggressive rate wars. It's almost like a tug of war, where even small shifts can ripple out significantly.
So, with these aggressive rate wars, are banks risking their margins just to keep mortgage demand buoyant?
Exactly, that's the gamble. And while default rates in Canada have been impressively low, around half the historical average, if mortgage demand drops drastically, that could spell trouble for lenders.
Yeah, I see. So it's not just about the rates lowering for relief, but also about balancing the risks of potential defaults and a possible recession triggered by trade conflicts.
Right on. Butler even mentioned that in a trade war scenario, inflation could creep up along with lower rents, factors that might lead to higher unemployment and eventually more default risk.
And yet, there's another perspective from Royal LePage's CEO who sees long-term stability despite the current slowdown, isn't there?
Yes, that's the balancing act. Phil Soper argues the housing market, though experiencing a temporary pullback, remains largely insulated from these trade disputes. He backs the idea that additional rate cuts might smooth over some of these bumps.
Right. It feels a bit like a seesaw. On one side, lower rates helping current borrowers, and on the other, a market that's cautious because of global uncertainties.
Exactly, it's the classic dance of risk versus reward. And if home prices in Ontario and possibly in British Columbia start grinding down, we could be looking at a subtle yet persistent shift in the market landscape.
Yeah, well, it's clear there's no one-size-fits-all answer here. The interplay between rate cuts, trade issues, and consumer confidence makes it a truly dynamic environment.
Absolutely, and watching how these factors continue to evolve will be key for anyone involved in real estate, from borrowers to banks.